Well, welcome back to our deep dive into PMBOK 5th edition. This module we're going to cover how we determine the project budget and set our project cost baseline. So finally here we are, 7.3 of our project cost management knowledge area. And after this, our last activity, we're going to talk about controlling the cost once we set our baseline. Here's our data flow diagram. We have coming in here, obviously, our scope baseline that has our WBS. We have our activity cost estimates that we just produced in our prior activity of 7.2, along with the basis of estimates, which will be used by budget to determine whether there's any final adjustments perhaps that have to be made. Of course, our resource calendars come in from both us and procurement also, right there, these two. And any agreements that exist come in because they cost money, so we need to know those too. And they will have also already been accounted for in our activity list. But agreements being the nature that they are, change controls go on. You change what you buy quite a bit sometimes, and they all need to be reflected on a timely manner, progressive elaboration again in our budget, especially before we baseline it. So you want to get as good as you can before you baseline, because you want to avoid as much as you can changing any baseline so that you can manage then out with all these distractions of changing things. I mean, that sounds like a utopian world, and in many respects it is, but do the very best you can to minimize that to the very minimum of all those kind of disruptions of having to re-baseline. The outputs, main outputs obviously is the cost baseline or the project budget. Same words, cost baseline, project budget, and the cost baseline of the budget goes directly into develop project management plan as one of its primary subsidiary plan components, which is along with the schedule baseline and scope baseline, your triple constraint baselines. The other main output from this process are your project funding requirements. Now that you have determined the budget, all the costing, and you have locked it down as a baseline, now, at that point anyway, you can determine from this point to the end of the project when you're going to need how much money to pay off either your internal people or your external suppliers, or pay anybody or anything that is in your activities as costs as you actually create or conduct and complete them. So a big thing, funding requirements. You don't want to get stuck not having money, for example, to pay a supplier that just delivered to you a $500,000 piece of big equipment for your project. You got to be able to pay them. Or there are other liabilities that you don't want to get into, legal litigation and stuff if it gets to that point. So make sure you have the money. Now, as we'll see, there are going to be some constraints and perhaps limitations on when that money may be available for a lot of reasons. And you should know this up front when we did our estimating costs, so that you have the proper items in your network plan costing, estimate cost to account for those things, so you know that you need to maybe delay something or wait until you have the money available and then go on. So, but do the best you can at the beginning to know all this stuff so that you can smoothly go through your project, execute the work, and make your payments both internally and externally smoothly and avoid problems in that manner. So we'll see about that. And of course, the project funding requirements, as you can see, pump directly into controlling your costs, which is what it is. You need to control it according to your plan and have money available to pay when needed. So, determine the budget, the objective. And the word aggregate we're going to see here a few times here now. We're going to aggregate all of the estimated activity and the work packages, costs up to control accounts, so that those are used to determine your project funding requirements all over for the entire project. And to establish the authorized cost baselines, you can monitor it in a good manner and control project performance. Inputs specifically, cost management plan. Why? Well, again, it has the units of measure, precision, accuracy, how you're going to handle your control accounts, what are your thresholds before you have to take some kind of action when your costing gets out of whack. A lot of earned value management may be discussed here under control thresholds. Remember, if you're at a 1.0 on your, we talked earlier about schedule variance, SV, and your SPI, your schedule performance index, where you can tell if you're at 1.0, you're right on schedule. If you start trending down 0.9, 0.98, 97, heaven help you if you get into 0.8 and 0.7 because you're way out of control. But if that happens, we have a similar concept with cost, which is your cost variance and your cost performance index, and that's where earned value management really comes in. So at some point the whole point here is that in your cost management plan, you're going to want to have some predetermined thresholds that, boy, if our cost gets down to 0.95, we seriously need to stop and think about what we're doing with our costing. Something is not right, something's out of control. So you set some thresholds where you absolutely have to think about and take some action to correct it. Before it gets to there, you see it start to fall, 0.98, 9.7, you know, take corrective actions yourself to try and bring it back in line. But if not possible, when it finally hits that threshold in your plan, because this is the plan, you have to do something special, and it'll tell you what to do in the plan. That's the whole point of that. Rules of performance measurement are the earned value computations and techniques that we're going to look at in great detail in our next module. And then, of course, reporting formats of, you know, how you want your cost expenditures profiles are reported to stakeholders and so on. That's part of the stakeholder plan, it's part of the communication plan, and of course part of the cost management plan. They all work together, they are integrated. Okay, that's integration is the whole key from the PMBOK methodology. Make sure everything functions together. You have all your inputs, outputs, they all make sense, and they all help each other produce a quality product and a successful project. Reporting format, we just said that. Cost management process descriptions, you may actually have some process flow charts that you could follow to help you do some of these things too. It depends on what you have, but if you do, it goes in the management plan. Scope baseline. What do you get from this? Here is where formal funding limitations and constraints by periods could be in your scope statement. And we'll see that coming up. Activity cost estimates that we did in the prior module, they come in and they're aggregated up. All these activity costs are aggregated up into work packages and eventually go up in your control accounts. And your companion is, remember, your basis of estimates. We say, how did I do it? And there are certain assumptions in there, especially for indirect costs that tend to be vaguer than direct costs that you know may happen. So whatever it is, these things come in as inputs to help you determine the budget. Project schedule, of course, helps you determine the budget because it is the one that sequences out when things are going to get expended. Okay, aggregate costs to your calendar periods. You know, depending on your organizational process, assets, and procedures, you know, they may have some very strict accounting rules for your project. You will report your costs weekly. You will report them monthly, quarterly, whatever it is. They'll tell you when they want to see aggregated costs and how they're expended on your project or planned for in the future on your project. Your resource calendars come in. Of course, that tells you, how much your people cost, etc. Your risk register. Primarily now, again, it's all about these risk response plans at this point in the project. They come in, they help you determine the budget, and if your risk response plans change, then there may be a change to your reserves, your management or contingency reserves. So you need to look at that now as input while you're getting ready to baseline your budget. Agreements, planned, estimated in the beginning, you plan them, or have you actually issued some purchase orders, some contracts, some commitments now, so you actually know what it's going to cost. Or, like we mentioned a little earlier, you may now have commitments, but you still don't know exactly what it's going to cost because of the nature of the pricing in the contract you have. Like a cost plus means, okay, I'm going to give you $500, but if we change things, you just add it on and we'll pay it. Okay, well, we don't know what that is, so estimate it. Organizational assets, again, your budgeting policies we just talked about, and procedures to do that. Budgeting tools you may have to help you aggregate these costs into work packages, and budgeting reporting methods. How do you report your expenditures and ask for funding and all that kind of thing. So things, again, you get from your organization will help you go a long way. You don't have to do it yourself. So here's some tools and techniques. I mentioned aggregation. We'll see it again. Here it is. We've already said that word several times, but let's look at it now because here's the technique that we're going to use to aggregate. You're just way down in the bottom here in your scope baseline. Again, you have your WBS activities that were either consolidated to some extent or used individually in your network diagram activities. So those discrete activities, whatever they are, cost-wise now, we did the same thing with time earlier, but cost, you aggregate those up into your work packages. So, and here you may have several work packages that you need to build, okay, to contribute to a larger deliverable up here, and eventually they roll up into a control account. Okay, more costs aggregated, and then the total of all the control accounts is your project budget. So, and that is what we're going to baseline eventually. So that's cost aggregation in that manner, and it makes total sense to do it this way. If you do it some other way, good luck, but maybe it'll work for you. But this is a good known way of doing things, best practice. You should really consider these control accounts and work packages. Okay, there's more coming up here, tools and techniques. There's quite a few here, so we're going to take a short break and come back in a minute. Okay, so here we are talking about our tools and techniques as a prelude to baselining our costs or our project budget. And we're talking about reserves analysis. Now here it is again, reserve analysis. You might recall a few modules ago, or maybe the last one, I showed you all the times we consider reviewing the reserve analysis, because you really need to keep this under control. It could save your life, save the project. So you really need to manage these reserves. So let's look at this. And I keep drilling this in because you need to know this stuff. The difference is contingency reserves are for the known unknowns, are for the known risks that you have identified, but you don't know if they're going to occur. But if they do, you have a reserve in the official project budget after we baseline it. So it's there for you. It's not going to go away. For the unknown risks that you have not identified, you don't know if they're going to occur. You don't even know what it is that may occur. But if it does, you're going to want to have money and time available to compensate for it, and that is your management reserves that are outside of your final project budget. They're up there, but they're at risk. And that should be in itself in your risk register about the possibility that a management reserve may evaporate if your company decides to take that money away from you. And it's your job then to convince them why you need to have that money. It's in their best interest. And of course, it all depends on the nature, the urgency, the visibility of your project in itself. If it's that high a visibility project, they may concede to you and say, yes, okay, we don't want anything to happen to this project at all. We'll let you keep the money. But if it's something like, well, okay, if that happens, it's not that big a deal from our standpoint. We'd like it to happen because, we funded you to support one of our mission statements with your project. But if, there's a problem, and then you'll have to just come to us and plead for money if that happens. So you don't know what's going to happen, but you really want to try and keep your management reserve intact if you can. And like I mentioned earlier, be nice to your company. As time goes on, you can feed some of that back to them. At your discretion, based on the profile of your risk at that time. So, okay, if you have $50,000 in there, you say, okay, here's 10,000. We don't think we'll need that. We think we're covered with 40. And then as you get closer to the end, you may give them another 10. Whatever you think is right to keep them happy, so they know that you are actually working in their best interest and you're good stewards of their money. Expert judgment, of course. Again, as you're about ready to baseline, you want to make sure, is everything in place, Mr. Expert? You've done this before. Am I missing anything? Help me here, and they'll give you help. Historical relationships. Remember, we talked about using your historical databases to determine budgeting amounts. It's a good tool to use. See what happened in prior projects. But here's some caveats with doing that, which we'll mention here, particularly that third one down. Historical information that you use has to be accurate. Now, this is historical information. It should be the actuals that actually happen, your actual costs. It should not be estimates that you're going after. You need to make sure they're the actual costs so that you're confident that you're using a good, solid, credible number, at least from a historical database or historical information point of view. And of course, whatever you're using has to be quantifiable, it has to be in dollars. You can't look in the history and say, boy, this item really cost a lot, more than we thought. Well, it's meaningless. So what are you going to do with that? Nothing. So it's got to be quantifiable, and it's got to be scalable to the extent that whatever you use, if it was a small project there, does that still apply to a large project and vice versa? So scalability, you need to consider whether it still applies to your project or not. And again, up at the top, parametric and analogous estimates are the methods you would use to determine budgets. So however you do it, are using good information that's reasonable and credible. Now here's your fund limit reconciliation. This is your planned funding at the time you lock the budget down, your cost baseline, versus funding limitations. Now you're, way back here, and well, not way back, but when we did 7.1 here and we planned for this costing, we talked about if it's a large enough pot of money you need for your project, your organization may actually have to float some bonds. They may have to sell extra stock if it's that huge an investment, if you're in that kind of project. So there may be limitations on the amount of money they will have at any particular time during the life of your project. So whatever you plan, you got to make sure that it's in sync with, will that money actually be available when my project says I need to fund it out. So that's what they're talking about here. Reconcile your planned funding expenditures with what you think you're actually going to be getting available from the company. And you may have to make adjustments in your schedule to compensate for that. So variances may require schedule adjustments, and basically you may have to impose some constraint dates. Okay, we're go up to, now we have to wait before we do this next chunk of expenditures so that funding is available to do it. Maybe that's never happened to you. Maybe it won't happen to you in the lifetime of your professional career, but if it does, and you're on that kind of project, you do need to consider these things because they will cause you grief later if you're up to the point where I need $2 million now to pay Joe over here and it's not there. Not a good thing. You should have known that in advance. So cost aggregation, primary focus, how you roll all the costs up so you can report them properly and reconfirm your budget. And then the funding limitation is the second one. Now that you have aggregated, can you actually fund it in that manner according to your network diagram? So tools and techniques, output. Now finally, here's your cost baseline or your project budget. It is the approved version of your budget at that point in time. And if you rebaseline it for whatever reason, then it's as of that point in time. Change control is always required now to move management reserve money that's just up there in the Ethernet. It's there, it's earmarked for you, although it may evaporate, and you need to make sure that doesn't happen, hopefully. But if you do use that for unknown risks to pay for them, to compensate for those events, you need then to take that money, change control, put it actually in your project budget now as an official expense, cost baseline. Project funding requirements. Here's a good example of what that looks like. And first, let's look at this diagram in the back. I'm not sure if we showed you this before, but let's look at it now. Both of these are in the PMBOK, by the way. Over here on the far right, here's all of your activities, whether it's a dozen or 1,200, whatever it is, all of your activities. The total costs are aggregated here. And well, let me rephrase that. These are just the raw costs for every activity, and you may have some contingency reserves in there for your known unknowns. They then go over here. See how the line here? The total of those now are the total of the work packages as they aggregate up to there. And then you would put some contingency reserves on top of that for more unknown or known unknowns. And the total of that become your control account as they aggregate up into that. Okay, so that's how those aggregations work. So now we're at the control account level that includes all of our cost estimates and all of our contingency reserves for known unknown risks. See what it says here? Contingency reserve is part of the cost baseline right there. So this rolls over, and right here is where you would baseline your budget, and it would become the cost baseline. And on top of that, you have your management reserve, which is the money you don't necessarily have control of, but you may need for unknown risk events. And that whole total thing is considered a project budget out here. But right here, see this? This is your project performance your performance measurement baseline. What's this? It's your performance measurement baseline. This right here, not including the management reserve, is what you are going to put your earned value against. You're going to manage your cost and your trending and your forecasting against that. Okay, so the budget here it does include management reserves as a budget, but the officially funded money is the cost baseline, and that is your performance measurement baseline that we'll see in our next module when we talk about earned value management. Now, to translate that down here into your funding requirements, as your network schedule is laid out, obviously it's time-based now, so at certain points when you execute activities, you're committing funds, and you need to pay somebody something for those funds, whether it's internal or external. So this is time down here, whatever calendar periods you're using, this is the amount of money. So obviously you start at zero, you haven't paid anything, and at the end, you're going to pay everything with a BAC, which is the balance at completion. This is an earned value term, balance at completion, whatever that is. So your expenditure, well here, your cost baseline says that if in the perfect world, we're going to execute our project, and these are the payments, these are the expenditures that we're going to incur as we do our activities. And here's your curve here. And now here's what you actually may do. I mean, this could be whatever it is on your project. It could be up here, down there. But let's say, you think you're going to start paying here, but you don't actually start incurring funds here for whatever reason. So you're under your budget, your cost, and here you go over your cost baseline. Not a good thing, but it just shows the dynamics between the baseline and the real world. And because, your finance organization isn't going to be like paying out every day. So, okay, I committed $15, paying $15. No, they're going to aggregate it up and pay in periodically, whether it's monthly, quarterly, whatever it is. That's what these steps are. So you may go some time before you get money, or you're going to get a bunch of money and you can spend it, and then it's going to stop. You get refunded. Your company may not keep $5 million in reserve for you. They may just keep $1 million, and then as you're going along, they'll go get another $500,000. They'll put it in their little money box, and then you'll ask for it here. Whoops, you ask for it here. You spend it, okay, and then you're down to nothing, or at least down to nothing as far as they're concerned. Then they'll fund it again. So they need to know when these funding levels hit, and you need to hit them. And now, if they're not going to get money here for a long time, you're going to have to stop and wait for the money. But you should know that in advance and compensate for it in your schedule. So this is a good graph to have. You should have something like that on your project, so you know when you're going to need money. And here's your management reserves up here that may or may not go away. And again, if you use some, they pump down here, and these funding requirements pump up because you've used them against that. So that's funding requirements. Okay, almost done. Project documents, your risk register, activity cost estimates, and your schedule, could all change every now and then because of the budget. But the big deal here is we now have a cost baseline, and we're ready to manage against it. So we're done with project budget. Now we're going to talk about controlling that budget, and we're going to get in some real nifty stuff with earned value management in our next module.